It's so important because the management and the company is the steward of their cash. And so they're the steward of our cash, I should say. And so what they choose to do with it matters. What we tell people is in the current low interest rate environment, if a company just holds cash, that's actually a pretty negative economic event to us because they're essentially holding it at a zero rate of return. So you're not going to find too many of our investments where we have a company that's just holding cash because the rate of return, we're looking for 20, they're investing at zero, math just doesn't work. Same thing really applies to companies that are paying down debt in a very low interest rate environment, unless there's something wrong with their capital structure where they're in fact being severely penalized because of their leverage. It's typically the case that we need the company to be more aggressive with the cash. But as I'd said earlier, acquisitions are good if you've got the people and the capability. Reinvesting in the core business through capital expenditure may be good. Same issue. Is it really growth? And what's the hurdle rate of the company? If it's, we're doing it because it's maintenance, no. So that's part of the discussion. Share repurchase is good, potentially, if the stock's cheap, but if the stock's expensive, may not be good. And so our view is, depending upon the opportunities there, if there aren't any good opportunities, just give us the money back. So that's why I said there isn't one right strategy. For each company, its point in its life cycle and the nature of the business, we'll have views, and those views will ultimately shape whether we want to be an investor. But just because a company is cheap today, if management is going to reinvest at very low rates of return, the fact that it's cheap today may be irrelevant to our ability to make our expected rate of return over time. And that's one thing that's one insight we think is very important, central to how we think.